You're listening to Investor Insights Decoded, the podcast where our hosts, Michael Grant and Julia Foster, break down the most impactful memos from the world of investing. Today, we'll be exploring Howard Marks's memo, Irrational Exuberance, written on the 2005. Let's dive into the timeless insights that continue to influence investors today. And if you're enjoying the content, don't forget to like, subscribe, and share your thoughts in the comments. Your support helps us bring more valuable insights to the investing community. Now, let's get started. Welcome to the deep dive. We got a lot of requests to take a closer look at this memo by Howard Marks, Irrational Exuberance.
Yeah, it's a classic.
It is, dated May 1st, 2000.
Yeah.
Right at the peak of the dot-com bubble.
A real time capsule. Marx was really sounding the alarm for his clients, trying to warn them about what happens when the market gets a little too...
Excited,
yeah, out of control. And his insights about how markets work, how investors behave, it's just as relevant today as it was back then.
And that's what we're going to do in this deep dive. We're going to break down Mark's main arguments, see where they're right on, where maybe they don't quite hold up, and most importantly...
how we can use them.
Yes, to become better investors.
Sounds good to me.
Okay, so imagine it's May 2000.
Okay.
The NASDAQ is going through the roof, especially all those tech stocks.
Everyone was talking about the new economy.
Right, like the old rules didn't matter anymore.
And valuations, forget about them. But as Marx points out in the memo, there were some cracks starting to show, some warning signs that, let's just say a lot of people chose to ignore.
Yeah.
Well, even Alan Greenspan, he was the Fed chair then, he'd been talking about irrational exuberance for years, since 96. But it didn't seem to matter. The market just kept climbing.
Yeah, I remember it's like anyone who even hinted that maybe things were getting a little too crazy, they were just labeled as like out of touch.
Dinosaurs, basically.
Mental dinosaurs. And to really hammer home this point about how dangerous it can be when the market gets, carried away.
Yeah.
Marx tells these stories, almost like cautionary tales, about some really big-time investors, guys who, in any other market, they were rock stars.
Right.
But during the dot-com boom, they either totally trashed and burned, or they were just...
ignored.
Exactly. Nobody wanted to hear what they had to say.
He named some heavy hitters, too. Julian Robertson.
Oh, yeah, he was legendary.
George Soros, Stanley Druckenmiller, Gary Brinson, Warren Buffett. It's fascinating because these are brilliant guys, right? They had systems, approaches that had worked for years, and suddenly it's like...
everything changed.
Yeah.
It wasn't that they became bad investors. It was like...
the market was playing a different game.
Right. So take Julian Robertson, for example. He ran this huge hedge fund, super successful.
One of the best.
But he just refused to buy tech stocks. Just absolutely refused. He said the valuations made no sense to him, no matter how you looked at them.
Looking back, you almost have to admire that kind of conviction. Sticking to your guns, even when everyone else is telling you you're wrong.
Yeah. But at the time, though, think about that. Seeing everyone around you making money, you're like, nope, not playing. Must have been tough.
It was. And it actually raises a really interesting question, a philosophical one almost. Are markets always rational? Or can they get caught up in these... I don't know, these moments where logic
just out the window.
Exactly. It's like, Is there something else at play? Something beyond just the numbers?
I think that's a key part of what Marx is getting at here. It's yes, markets are efficient.
Mostly.
In the long run.
Yeah.
But there are times when, when emotions take over. When fear and greed.
They distort things.
Yes. It's like the market becomes this...
This beast.
Yes. This beast that just throws logic out the window.
And to illustrate that, he talks about George Soros and Stanley Druckenmiller.
Another powerhouse duo.
Right. This is a hedge fund known for making big, bold bets. And Druckenmiller, he was the one who actually managed the money. He had this reputation for being incredibly good at timing the market.
So even HE got sucked into the dot-com frenzy.
He did. Early 99, finally caved, started buying tech stocks, and then boom. Market turns. Yeah, losses piled up. And it just goes to show you, even someone like Druckenmiller with all his experience and discipline,
nobody's immune.
No one to that kind of psychological pull, especially when you're surrounded by people making a killing. It's hard not to get swept up in it.
Okay, and Marx talks about some other big investors too, right?
Oh, yeah. There's Gary Brinson.
Remind me, he was
a value investor, like a pioneer of that whole approach.
which is all about
Buying companies that are undervalued.
right, based on their
Their fundamentals, their earnings, their assets, all that good stuff.
Okay, so what happened to him during the dot-com boom?
Well, as you can imagine, when the market's going crazy for growth stocks, companies that are just chugging along, making steady profit.
Don't look so sexy.
Nope. And Brinson, he stuck to his guns, but his style was so out of favor, he actually ended up resigning from his own firm in 1999. Couldn't reconcile what the market was doing with his whole philosophy of investing.
Wow. I mean, it's got to be tough to see your whole approach being rejected, even though it's got this proven track record, right?
It is, and it highlights this really important lesson, I think, for investors. You've got to be aware of what's happening in the market, the trends, but don't abandon your core principles just because they're not hot at that particular moment.
Right. It's like, this time it's different. Famous last words.
Famous last words, yeah.
And even Warren Buffett wasn't immune to the dot-com craziness, was he?
No, he wasn't. Berkshire Hathaway, his company, took a real beating. Stock price dropped a lot. Suddenly, people were acting like
He lost it.
he was this relic of the past.
Yeah, but obviously he hadn't.
Nope. Buffett he kept doing his thing. Disciplined, patient, waiting for the market to calm down.
And when the bubble burst, what happened?
Berkshire stock came roaring back. It was almost like a vindication of his whole approach.
It's amazing. So what Marx is saying is, even the most brilliant investors out there, these guys who are legends,
Yeah.
they can still get tripped up by.
Market psychology.
Exactly. When everyone's getting caught up in the excitement,
Euphoria.
it's hard to stay level-headed, to not get swept up in it.
Yeah, and Marx argues that a big part of what fueled this irrational exuberance in the late 90s was this declining emphasis on fundamental analysis.
Okay, let's break that down. When he talks about fundamental analysis, what exactly does he mean?
It's all about figuring out a company's real worth.
Okay.
Not just what the stock price is doing, but digging into its finances, its business model, its potential for growth. You're looking at things like earnings, cash flow, dividends, all that stuff.
You're trying to figure out.
If the company is actually worth what people are paying for it,
Right.
or is it overvalued, undervalued?
So it's not just about the hype, it's about...
A substance.
Right. But what Marx is saying is, in the late 90s, investors started ignoring that stuff. They weren't paying attention to the fundamentals anymore.
Right. And he's saying that was a big problem.
Okay, so what were people focused on instead? What was driving the market if it wasn't the fundamentals?
Well, Marx points to a few things. For starters, the rise of the retail investor.
Okay, so more regular people getting into the stock market.
Exactly. And often these were folks who didn't have a lot of experience. Maybe they weren't as focused on the long term.
They were just chasing the hot stocks.
Right. Looking for quick wins. And that kind of mentality, it makes the market more prone to these big swings, these emotional ups and downs.
It's like they were buying into the story, the excitement, not necessarily the...
Not the underlying reality.
Yeah. And I'm guessing the internet played a role here too, right? I mean, suddenly it was so easy to buy and sell stocks, to get information.
Absolutely. The internet democratized access to the markets, which was great in a lot of ways, but it also meant that there was this flood of information, and a lot of it wasn't very good.
It was hard to tell what was real and what was just hype.
Right. And it made it easier for these speculative bubbles to form because people were getting caught up in the latest trends, the hottest tips.
Without really doing their homework.
Exactly. And then on top of that, Marx talks about how the role of sell-side analysts was changing.
Okay, remind me. Sell-side analysts, they're the ones who work for?
The big investment banks, the brokerage firms.
Right. And their job is to...
Research companies give investment recommendations to their clients.
Okay, so what was changing with them?
Well, traditionally, their job was to be objective, right? To give their honest assessment of a company, even if it meant saying,
Sell.
yeah, this stock is overvalued, get out now.
Yeah.
But in the 90s, the investment banks, they were getting more and more involved in these big deals like underwriting IPOs for tech companies.
So they had a conflict of interest.
Exactly. If their analysts were putting out negative reports about these companies, it could hurt their chances of getting those deals.
So there was a lot of pressure on analysts to...
Say positive. To keep the hype train rolling, even if it meant...
bending the truth a little.
A little, or maybe a lot in some cases.
So it's like you had all these factors coming together, right?
Mm.
New investors flooding the market. The internet making it easier to trade and spread information, whether it's good or bad.
Yeah.
And then the analysts, who were supposed to be these objective voices, they were kind of
Caught up in the frenzy, too.
And all of that
Fueled the bubble.
Exactly. It created this perfect storm for irrational exuberance.
And Marx argues that all of this led to a market where simplistic thinking was the norm.
Okay. Simplistic thinking. What do you mean by that?
Well, instead of really digging deep doing the research, people were just following the herd.
Right. Like, buy whatever's going up.
Exactly. It was all about momentum.
The trend is your friend.
Mhm.
Until it isn't.
Until it isn't. And then you had this other idea, buy the dips.
Like, anytime the market dropped a little, it was a buying opportunity.
Yeah, without really considering, why is it dropping? Is there a reason to be worried?
Or is it just, a natural blip?
Right. And then, of course, there's the opposite of that, which is panic selling.
Right. As soon as things start going down.
Everyone wants to get out at the same time.
Which just makes things worse.
Exactly. And all of this, combined with the decline of fundamental analysis.
It created this market where prices were completely disconnected from
reality.
Yeah. It's like people were buying dreams instead of actual companies.
That's a great way to put it.
So if I'm hearing you right, Marx is basically saying, don't get caught up in the hype.
Right.
Stay focused on the fundamentals.
Right.
Have a disciplined approach. Don't let your emotions take over.
Exactly.
Okay, this is all great stuff, really eye-opening, but Marx isn't totally anti-efficient market hypothesis, right? He doesn't think the whole idea is
bunk.
Yeah. He just thinks we need to understand it in a more nuanced way.
Exactly. He actually has this really interesting perspective on market efficiency that I think is especially relevant for investors today.
Okay, let's hear it. What's his take?
So Marx, he's saying markets are efficient in one sense. They're really good at incorporating new information.
Okay, so when news breaks, events happen, that stuff gets reflected in prices pretty quickly.
Exactly. But, and this is where it gets tricky, that doesn't mean the market is always right about what that information means.
Ah, okay. I see where you're going with this.
Yeah.
Just because the market reacts fast doesn't mean it's reacting correctly.
Exactly. Like, think about a scale, a really precise one. The scale itself might be perfect, but if you put the wrong stuff on it...
You get the wrong weight.
Right. So the market might be super efficient at processing information, reflecting the consensus view.
But that consensus could be...
flawed.
Yeah, like based on bad data, wishful thinking, or just plain...
Emotion.
And that's where the irrational exuberance comes in. Marx is saying sometimes those wrong things on the scale, they're psychological.
Right. Biases, herd mentality, and that detachment from fundamentals we talked about.
So the market might be efficiently showing us what everyone's thinking and feeling.
But not necessarily the truth.
Whoa. So how do we protect ourselves from that? How do we as investors not get swept up in those waves of irrationality?
Well, Marx gives us a few clues. First off, watch out for trends that just defy common sense. He brings up this book, Dow 36,000. Came out in 99.
Oh, yeah, I remember that. Weren't they say the Dow was going to hit like some crazy number?
Yep, 36,000. And their reasoning was, well, it was a little out there.
How so?
They were basically saying stocks, in the long run, they're less risky than bonds, so they shouldn't give you a higher return.
Wait, they were saying stocks should have a lower return than bonds. That seems backwards.
It does, right. But they claimed the only way this makes sense is if stock prices go way higher. Like Dow, 36,000 high.
So they were just ignoring valuations.
Pretty much, saying it doesn't matter. Stocks can just keep rising forever as long as people believe they will.
But that ignores like the whole idea of risk and return, right? You expect the higher return from stocks because they're riskier than bonds.
Exactly. Marx, he just dismantles their argument. He's like, who's going to buy stocks to make like 6% a year? If that's all you're going to get, why not just stick with bonds? Way less risky.
It's such a simple point, but so powerful.
And it shows us something important. Be skeptical of any prediction that just sounds too good to be true.
Or anything that claims this time is different.
Oh yeah, classic red flag.
So don't get caught up in the hype. Always ask, does this make sense?
Exactly. And another thing Marx talks about is cycles. Markets move in cycles. You've got your periods of irrational exuberance.
And then the crash.
Right. It's not if it will happen, it's when.
So we got to know where we are in that cycle and adjust accordingly.
Exactly. Seeing signs of crazy optimism, speculation running wild. Maybe it's time to be a little more cautious, even if everyone else is making a ton of money.
And on the flip side, when everyone's freaking out,
that might be the best time to buy.
that's why it's so important to have a plan, right? a long-term strategy, so you don't get swayed by all the short-term noise.
Absolutely. Now, it's not just us influencing the market, The market can mess with our heads, too. Marx talks about this with liquidity.
Okay. Liquidity, that's basically how.
How easy it is to buy or sell something. In this case, stocks. When the market's booming, lots of liquidity. Feels great, right? Everyone's confident, trading is smooth. But now market turns south.
Suddenly, everyone wants out at the same time.
And that same liquidity that felt so good, it becomes a problem.
It's like a trap.
It can be. And it shows how our own behavior, it can actually make the market swing even more wildly.
So if you panic and sell,
You might be making things worse, not just for yourself, but for everyone.
so stay calm, don't overreact, stick to the plan.
Exactly. What seems like a good thing in a rising market being able to trade easily, it can turn on you when things go bad.
This all goes back to having that clear investment strategy. If you know why you're invested and you're okay with the risks,
You're less likely to freak out when the market dips.
makes sense. So we've got to watch out for ourselves, our own biases, but also keep an eye on what everyone else is doing. Marx actually lists a bunch of classic investing principles, things that usually work really well.
Yeah,
But in 1999, they were a recipe for disaster.
totally. It was like the old rule book didn't apply anymore.
Give me some examples. What kind of stuff stopped working?
Things like wanting both appreciation and income from your investments, balancing growth stocks with value stocks, buying companies that had a history of, actually making money.
So basically all the common sense stuff.
It went out the window. In a pure speculative market, the only thing that mattered was getting on board the hottest trends, whatever was going up the fastest.
Sounds dangerous.
It was. And Mark's point is, those fundamental principles, they still matter, even when the market's going through a crazy phase.
Right. And he's also warning us about extrapolating, assuming that just because something's been working for a while.
It'll keep working forever.
Yeah, like the market always goes up. Famous last words, part 2.
Right. We got to be able to adapt.
So how do we know when it's time to shift gears? When the market's getting ahead of itself?
Marx says, watch how other people are acting. When you start seeing signs of too much greed, everyone getting complacent.
The herd mentality kicks in.
Yep. That's when you got to be extra careful.
He actually quotes Buffett here. It's a great line.
Oh, yeah. What is it? The less prudence with which others conduct their affairs.
The greater the prudence with which we should conduct our own affairs.
There you go. Basically saying when everyone else is being reckless, that's when you got to be the most careful.
But it's hard, right, to go against the crowd, especially when it feels like they're all getting rich.
It is. Takes a lot of discipline.
Marx gets that. He knows even the smartest people can make mistakes when the pressure's on.
He's got this great section in the Memo where he talks about his own struggles during the dot-com bubble.
Oh, really? So even Howard Marks, the guy who wrote the book on Irrational Exuberance, he got caught up in it.
He did. He said there was this point in '99 where he was pretty sure the market was overvalued.
Uh-oh.
Yeah. But he hesitated to sell.
Why? If he thought it was going to crash, why not get out?
He says he got caught up in the mood of the time. Everyone was so bullish, so confident. He was worried he'd miss out if he sold too early.
So even he felt the FOMO.
He did. And looking back, he admits it cost him money. He did end up selling some of his holdings, but not enough.
It's a good reminder that we're all human. We all have these biases, and it's helpful to have a process, right?
Yeah.
Like a set of rules for making investment decisions.
Absolutely. Something to help you stay grounded when your emotions are running wild.
Don't just react in the moment. Have a plan.
Exactly. And Marx, he's got this other great concept he talks about, second-level thinking.
Okay, I've heard of that. What's that all about?
It's about thinking beyond the obvious, going deeper than what everyone else is seeing.
So it's not enough to just spot a trend.
Nope. You got to think about what are the things that other people might be missing? What are the second-order effects?
Give me an example.
Sure. Back in '99, the Fed started raising interest rates. Most investors, their reaction was,
That's bad for stocks.
right? Higher rates usually mean?
Companies have to pay more to borrow money. Consumers spend less.
Exactly. That's like first-level thinking.
All right, so what would a second-level thinker do?
They might say, hold on, what if the Fed raising rates is actually a good sign?
How could that be?
Because it might mean the Fed is confident about the economy. They're raising rates to prevent inflation from getting out of control.
So it's not just about the direct effect of higher rates.
It's about what it signals, what it tells us about the bigger picture.
And in this case, what happened?
The market actually went up when the Fed raised rates. The second-level thinkers, they were right.
Wow. So how do we train ourselves to think like that? To see what other people are missing?
It takes practice, honestly. But one thing you can do is start questioning your assumptions. Every time you have an idea about why the market is doing something.
Ask yourself, is there another explanation?
Exactly. And don't be afraid to be wrong. That's how you learn.
And read a lot. Get different perspectives.
Yeah. Don't just listen to the people who agree with you. Talk to people who have different views. Read different sources.
Don't get stuck in an echo chamber.
Exactly. And honestly, one of the best ways to learn is study the mistakes of others.
That's where Marx's memo is so helpful, right?
Yeah.
He's not just giving us advice, he's showing us what not to do.
Right. Learning from the past so we don't repeat the same mistakes.
Okay, so Marx wants us to be skeptical, to think for ourselves, to not get caught up in the hype. But he also offers some more concrete advice, right?
Yeah.
Actionable steps we can take to be better investors.
Absolutely. He lays out some key principles that can help us navigate the markets even when things are getting a little exuberant.
Okay, let's hear them. What are some of those actionable takeaways?
First and foremost, stick to your discipline. Base your decisions on those fundamentals we talked about. Earnings, cash flow, valuations.
Back to basics.
Always. And remember, just because a stock is trading at a certain price
Doesn't mean it's actually worth that price.
Right. We got to be able to separate price from value. And that takes doing your homework.
Research.
Right. And then, this is a big one. Be willing to be a contrarian.
Okay, what do you mean by that?
If everyone's rushing into something, a stock, a sector, whatever, and you think it's overvalued, don't be afraid to.
Sit it out.
Yeah. Go against the grain.
That's hard though, right? When everyone else is making money, it's tough to be the one who says,
nope, I'm not playing.
Right. It takes courage.
It does. But Marx, he says that's often when the best opportunities appear.
When everyone else is wrong.
Yeah.
Interesting. Okay. Anything else we should be doing?
Remember those cycles we talked about? Well, just like those periods of irrational exuberance.
Which lead to crashes.
There are also times when the market gets too pessimistic. Everyone's selling, prices are dropping.
And that's when
the value investors come in, they see those bargains that everyone else is overlooking.
So we've got to be prepared to buy when everyone else is scared.
Exactly. But also, remember, we can't predict the future. Even the best investors, they get things wrong sometimes.
So stay humble.
Always. And focus on managing your risk. It's not just about making money, it's also about protecting what you already have.
Diversification. Hedging.
All that good stuff. And finally, keep the big picture in mind. Don't get lost in the day-to-day noise of the market. Focus on your long-term goals.
Don't let the market dictate your emotions. You dictate your emotions.
Exactly. And speaking of emotions, Marx, he actually tells the story about a young fund manager, Frank P. Slattery V. His fund, PBHG New Opportunities Fund, it was killing it in '99.
How well are we talking?
Up 533% in 1 year.
Whoa.
And then another 96% in the first couple months of 2000. Amazing returns, right? But
there's always but, isn't there?
Right. Marx points out those kinds of returns, they were only possible because the market was so speculative. And sure enough, when the bubble burst,
What happened?
Slattery's fund lost over 57% of its value in a matter of weeks.
Wow. That's brutal.
It is. And it shows what can happen when you chase performance without paying attention to the fundamentals.
Right. Past performance doesn't guarantee future results, especially when those results came from, a superheated market.
Exactly. And it brings us back to one of Marx's core themes here, understanding market psychology.
Yeah, he keeps coming back to that. It's like we need to look beyond just the numbers and understand the
human element.
The human element. And one of the biggest parts of that is the herd mentality.
Ah, yes. The urge to follow the crowd, even when it's not a good idea.
If everyone jumped off a bridge.
Right. And in the market, that herd mentality, it's what leads to those bubbles and crashes, people buying or selling just because everyone else is doing it.
Like, this stock is going up, I better buy it too, even though I have no idea why it's going up.
Or the opposite. Everyone's selling, got to get out now, even if you think the company is actually good value.
It's like our brains are wired to follow the crowd.
To some extent, yeah. So we got to be aware of that and trying to fight against it.
So how do we do that? How do we avoid getting trampled by the herd?
Develop your own judgment. Be willing to stand apart from the crowd.
Easier said than done.
For sure. That's why it's so important to have a strong investment philosophy, to do your own research, to be confident in your own analysis.
So we got to do our homework and then Be brave.
Be brave, yeah. And, one of the best ways to spot a bubble forming is to look for signs of that herd mentality, everyone piling into something without really thinking about why.
Watch out for the hype.
The excitement that this time it's different talk.
Yeah, that always seems to come with a bubble, doesn't it?
It does.
Okay, this has been amazing. I feel like I'm starting to see how all this stuff from the dot-com bubble.
It applies to today.
Exactly.
That's why Marx's memo is so valuable. It's not just about the past. It's about understanding the timeless principles that drive markets.
And understanding ourselves, our own psychology.
Right. We all have those biases, those emotional triggers. Knowing what they are, that's half the battle.
So be skeptical, think critically, don't follow the herd blindly.
And have a plan.
Right. A plan you can stick to, even when the market's going crazy.
Now, Marx ends his memo with this really striking postscript. He includes a table that shows how all these high-flying tech stocks, what happened to them after the bubble burst.
Yeah, like putting his predictions to the test.
Exactly. It's like he was saying, see, I told you, but with hard data.
So what did the table show?
A lot of those hot tech stocks, they lost like 80%, even more of their value in just a few months.
Wow. That's rough. Makes you think twice about chasing the next big thing, doesn't it?
It does. And it reminds us no matter how good things seem, gotta be prepared for when the music stops.
So what can investors do to get ready for those inevitable downturns? I mean, we've talked about having a plan, sticking to the fundamentals, not getting swept up in the hype. What else?
Marx is big on managing risk, not putting all your money into one thing, understanding how much risk you can actually handle, and maybe most importantly, having a plan for when the market drops. Because it will drop, it's not a matter of if.
Yeah, it makes sense. When everyone's making money, it's easy to feel invincible. But when things go south,
that's when you need that plan.
Okay, so all this stuff about irrational exuberance, it's interesting, but maybe you're listening to this thinking, wasn't that just a one-time thing? The dot-com bubble, that was over 20 years ago. Have we learned our lesson? Are markets more rational now?
Great question. And yeah, we've definitely learned some things. But here's the thing. The things that drive irrational exuberance, greed, fear, the herd mentality, those are human emotions.
They never go away.
Nope. And we've seen this pattern over and over in different markets. Real estate in the mid-2000s, crypto more recently.
So Marx is saying these booms and busts, they're just part of the game.
Yeah. And knowing that, being able to spot the warning signs.
That's how you win in the long run.
Exactly.
So always be on guard.
Always. Doesn't matter what the market's doing. Be skeptical. Stick to your principles.
And remember, those cycles are coming.
They are.
This is great stuff. Marx, he actually leaves us with a really thought-provoking question at the end of his memo. He says, if markets are truly efficient, why are they so volatile? Why all the crazy swings up and down? Is it really just people reacting to news and events? Or is there something else going on?
Something to think about.
It is. Thanks for joining us for the deep dive.
Yep.